Good morning, ladies and gentlemen. It's a pleasure to be here, and I would like to thank Jeff Berwick and his team for their kind invitation to have this opportunity to talk about money and liberty. Now, obviously, if you're a hermit, you don't need to worry about money, and you have all of the liberty that you can handle. But none of us in this room, I believe, are hermits, and these two words are very much intertwined with one another. So what I'd like to do this morning is share with you some of my own experiences on the chance that they'll be helpful. And it goes back to shortly after graduating from college in the 1960s. I joined Chase Manhattan Bank, which is now JP Morgan Chase, as you probably know, and landed in Hong Kong in 1971. A new guy, just starting my career. I read everything I could get my hands on, both fiction and nonfiction. And I came across a couple of novels by a writer by the name of James Clavell. And you may know the books. One's called Taipan and the other one's called Shogun. And in that book, he talks about drop-dead money. And it was a very curious thing that sort of stuck with me over the years. But drop-dead money was basically you could go up to your boss and say, drop dead. You walk away from that job and you still have the wealth and the liberty that you would like to achieve or like to have so that you could go anywhere in the world. And I thought that's a pretty good concept. I'm going to work toward that. And over the past 50 years, I think I have achieved it. When I was in Thailand in the early 1970s, imagine Vietnam War was at its height. Everybody was concerned that the Red Chinese are going to come across the border. So what we did is we developed what we called a last plane account. And we went around talking to wealthy Thai businessmen and said, what happens if the Red Chinese do come across the border? What are you going to do? You want to get on the last plane with your family, go live somewhere else comfortably until sanity returns to your country. You then move back, you open up your factory once again under new conditions, under new circumstances, and live happily there ever after. And it sort of ties into this concept that you've been hearing about PT, permanent traveler, and all of the other symbols that are associated with it. And again, that's something that stuck with me when Harry Schultz, who was a newsletter writer back in the 70s and 80s, first introduced it. I used to subscribe to his newsletter and read a lot about his thinking and how you could achieve money and liberty in a world that's not very free. Lenin said that you destroy society by destroying the currency. And the truth to that statement can be seen by looking at Venezuela today. The economy, the society has been literally destroyed, and the people who managed to get out of the country are waiting for the opportunity to go back into their home. But it's this kind of environment that we live in that we have to think about money and liberty. Now, I want to show you an article from the Wall Street Journal. This appeared last month. It's quite clear. U.S. warns Iraq that risks losing access to key bank accounts if troops told to leave. Now, let's black out Iraq and let's put in your name. If the U.S. warns John Doe or Jane Doe, it risks losing access to their key bank account if you put in the if. If you have the wrong religion or the religion that the government thinks is wrong, or if your skin color is what the government thinks is wrong, or if silly things, because politicians are so capricious, you don't know what they're going to do. An example that I read just recently in Dominic Frisby's new book, Daylight Robbery, which I highly recommend. If you were in Russia and you had a beard, you had to pay a tax. So, think of anything that would be of a possibility that would take you away from your bank account, from your currency, from your opportunity to participate in society. In today's world, money has become a weapon. It's no longer a neutral tool used in commerce, which is what money is supposed to be. So to help prepare for an uncertain future that cannot be predicted, let's examine money and its link to liberty. And to do this, let's go back to basics. So some of the things I'm going to be talking about today you might find a little bit surprising, but they've been very helpful to me, and I'm very happy to share these concepts with you. Let me start by saying that if Iraq had owned money instead of currency, it would not have been at risk. And this distinction between money on the one hand and currency on the other is very important. We often use these two words interchangeably today, but you have two words for two different things. There's a Chinese saying, one that I'm very fond of, that wisdom begins by calling things by their right name. So I want to make this distinction throughout my presentation between money on the one hand and currency on the other. And by the time this presentation is over, I hope you all will understand why I'm making this key distinction between those two words. The corollary to this Chinese saying is that liberties can be lost when the state takes a word and misuses it. And few words today are more misused than money, which is a reality very convenient for those governments that like to swallow up individual liberties. The American Constitution is a wonderful document, and before I explain this particular section, I want to introduce you to a concept that I've used to come to understand exactly what that document means to each and every American. Conceptually, as the framers of the Constitution understood it, law begins with us individuals, and it's like a waterfall. Imagine a waterfall with individuals at the top. We delegate certain authorities to the state, and we agree that as long as the state follows those authorities that we delegate to them, we will continue to follow the laws. And then the states, in turn, delegated 18 specific powers to the federal government. So at the bottom of the waterfall is the federal government. What's happened today is that waterfall has been turned upside down. The government thinks it's at the top, and us individuals are at the very bottom. Now, what I'd like to do is to explain the monetary powers which have been delegated to Congress. They have been delegated to the executive office. They've been delegated to Congress. And here's what it says. The Congress has the power to coin money. To coin money. Not to print money. The framers of the Constitution understood the difference between money and currency, and they recognized the problems of printing. But, this phrase, and particularly the next part of that, to regulate the value thereof, when you read it, it would seem to say that the Federal Reserve has the power to regulate the currency in the country. But to regulate the value thereof is the value of the money that is being coined. So why do we have a Federal Reserve system, which is essentially an unconstitutional monetary system in America today? It's because those powers have been taken away from the individual. That waterfall has been turned upside down. There's another part to Section 10. It's that no state shall emit bills of credit or make anything but gold and silver coin a tender in payment of debts. Now, you might be scratching your head saying, well, what's a bill of credit? Well, in our pockets, we have dollar bills of credit. That's what a bill of credit is. It's this paper currency that's circulating throughout the United States, and the states use it willingly, despite the fact that the Constitution says that no state shall emit bills of credit or make anything but gold and silver coin a tender in payment of debts. Again, things that the framers of that Constitution understood and left for us have been misinterpreted over the decades. We find ourselves in the present situation. But all of the solutions to today's monetary problems are in the Constitution. All politicians have to do is to read that document and follow what it says, understand the original intent of the framers in order to look at what we should be doing today to solve the problems that we all see and understand and know. So what is money? It's not what most people think it is. Money is a tangible asset that extinguishes an exchange. Now, I'd like to explain this by using an example. If we go into a shop and we put down some gold or silver coins to purchase some good or to purchase some service, we walk away with the good or service, and the shopkeeper has his gold and silver coins. The exchange is extinguished at the moment that those coins are given in return for the good or service that we walk away with. There's no lingering obligation. The merchant doesn't have any payment risk. He knows he can take that tangible asset and go out and use it in turn to purchase other goods and services. But if that's money, then what is currency? Well, there are two types of things that we have to look at as currency. Tangible assets circulating current, like gold and silver coins, are a form of currency. We don't see that too much today. In my lifetime, I remember silver coins circulating when I was a young kid. I've traveled to other countries where you can purchase things with gold or silver coins, but it doesn't happen that much. To purchase real estate, I understand, in Vietnam, you have to have gold. To purchase rental space in the bazaar in Turkey, you have to do that with gold. And a few other places perhaps, but it's not done very much. But that's one form of currency, a tangible asset circulating as circulating current. But it's also anything that is not a tangible asset and is used in an exchange. Now, when I'm talking about anything, I literally mean anything. We use paper, we use credit cards, debit cards, checks, and things like that. But these are just currency, they're not money, because the person who accepts that non-tangible asset has payment risk. He'll take those dollars, whether they're in currency or run through his computer on a credit Visa or MasterCard system. He'll take those dollars, but until he gets rid of those dollars, he has payment risk. Payment risk is that those dollars may not have the purchasing power when he spends it that he did when he received it. And we know in 2008, or if you go back to the Great Depression in the 1930s, a lot of people thought that they had purchasing power with the currency that they were holding, but found out that, hey, banks do fail. And if a bank fails, I might not actually have the purchasing power I thought I did. Or alternatively, you don't have the purchasing power that you think you do when you're in an inflationary environment. Because a year out, you'll have less purchasing power than you did today, and the interest income that you earn over that course of the year will not be enough to offset the loss of purchasing power because of the debasement of the currency from inflation. And this is particularly true today, when we're in a world in which, even the mainstream media admits it, it's called financial repression. Its central banks are doing things to perpetuate the power of governments, taking away the wealth and purchasing power of us individuals. So currency can be a tangible asset or a non-tangible asset, but here's the kicker. Today's monetary and financial system has been, from the very beginning, built on a rickety foundation. It's the false notion that more money means greater wealth, and that's not true. If you double the quantity of currency, or double even the quantity of money, you don't necessarily have more wealth, because gold itself is a sterile asset. It doesn't generate wealth. What happens when the gold price goes up, you're taking, and you're owning gold, and let's say it's going up in the price of US dollars, you're taking purchasing power from people who are owning US dollars, and you're receiving that purchasing power in terms of the higher gold price. So where we are today is that we live in a world in which we have financial repression, and although the word barbarous relic is used quite a bit, the real barbarous relic is not gold. The barbarous relic is central banking. And I think we're going to learn this more and more in the years ahead, because central banks seem intent in perpetuating this notion that they will keep governments in power regardless if they have to destroy the currency to do it. I want to go through a process to better explain this difference between money and currency and the 17th century notion about fractional reserve banking and the fact that if you double the quantity of money, you're not necessarily increasing the better off of the general welfare of a country. Back in the old days, gold and silver coins circulated current. And this is true pretty much throughout the world. Even in the United States, after the framing of the Constitution and its acceptance by the original 13 states, there were private mints and private minters making gold and silver coins, most of which were better than what Congress itself was making, and those coins tended to have a premium to what the US government was doing. Under the classical gold standard, though, what happened in 1694 with the creation of the Bank of England, you now had a piece of paper circulating in place of gold or silver. And there was a certain logic to that. It was easier to use in commerce when you're moving paper around rather than when you're moving a heavy metal around. Also, the heavy metal could get scratched or worn out from, in commerce, when people were grabbing it and touching it. You know how coins get worn out. That would happen to the metal, and that metal would be gone forever when a coin is worn out in that direction. So the Bank of England came up with this great invention and said, well, look, you keep the gold and silver in the vault, and we'll give you this piece of paper, and it's even better to use. And whenever you want the gold or silver, just come back, and we'll pay you the gold or silver and redeem that particular note. This is fractional reserve banking, because what the Bank of England did is if for a balance sheet of 100, they had 40 in gold, 100 in liabilities, 60 was just created out of thin air, and that's the whole concept of fractional reserve banking. Then in 1844, there was another development. This was Peel's Bank Act. Peel, who was the prime minister at the time, said that the pound is being debased because too much currency is being created by the Bank of England. So we're going to put a limit of 10 million pounds on the total amount of British banknotes that could be circulating as currency. What he didn't realize is that the bankers are show a lot of initiative and creativity, and they came up with this concept of deposit currency. In other words, they created a different type of liability. It was an account that they would maintain for you at the bank, what we today call a current account or a checking account. So prior to 1844, if you went to borrow 100 pounds from the bank, they would give you a 100-pound note. After 1844, you'd borrow 100 pounds, you'd walk out with a checkbook. And this was the whole creation of deposit currency. And today, most currency is deposit currency. It's a liability on the bank, on some financial institution, typically banks, and it's approximately 93% of all the currency in circulation is deposit currency in one form or another. Now, what we've had since 1971 is fiat currency, which is backed by a big question mark. It's backed by promises. All of the gold has been essentially, and silver, have been essentially removed from the banking system, and now we're based on the promises of government to always make sure that the banks get bailed out and depositors don't lose money. You're also basing this on your faith in bankers. They're going to make good loans and they're not going to incur any losses. But as we saw in 2008 and throughout other monetary crises throughout history, bankers don't always make good decisions because, after all, we're only human. This is not a perfect world, so you can't expect the bankers get it right 100% of the time. And what they typically do is, you'll see a little bit more when we work further into the presentation, the banks tend to overextend themselves. And when they overextend themselves, they make more bad losses than they have capital to absorb those bad losses. And as a consequence of that, they then end up losing money and collapsing and either get bailed out or fold. And we are in a situation today where we have a very, very fragile banking system. And you may be reading about all of this repo printing that the Federal Reserve is doing presently to try to keep the banking system afloat. There's a liquidity crunch underway. And how that's going to play out, time will tell. It's an interesting thing because you can always look at monetary history and see what happened, but we just don't know how things are going to unfold because nobody can predict the future. So the best thing you can do is look backward and take those steps that deem prudent based on what has worked for you in the past or what has worked for others in the past and apply it to the present situation. So I'm going to get into this concept of fear a little bit more later on, but when you're basing your currency, which is the liabilities that the bank has, to you, in other words, when you have gold and silver coins, that is money you own. When you have dollars or British pounds or Swiss francs or anything else, that is currency that is owed to you by the banks. And the fear comes as to whether or not that currency is going to be good when you want to spend it. When you want to realize the hard work that you expended in order to obtain that currency, and you want to buy some goods or services or give a gift to your children or grandchildren, and it creates fear. I'll get back to this in more detail in just a minute. So where does cryptocurrency fit into this picture? It's not called crypto money for a reason. Now, that doesn't mean I'm disparaging cryptocurrency, because I'm not. I'm actually quite keen on it. I'm one of these people who believe that Bitcoin is going to go to 100,000 by the time 2022 comes rolling around. But that's not necessarily saying you're going to make money in Bitcoin. or necessarily increase your purchasing power or create wealth. You'll be taking wealth or purchasing power from people who own fiat currencies, because I really do believe that fiat currencies are going to continue to be inflated away and they'll be losing purchasing power. But I want to explain this notion of cryptocurrencies a little bit more and explain a little bit going back to the founding of Goldmoney back in 2001, because this very much ties into the money and liberty concept, which this whole presentation is about. Remember, I was talking about in the 1970s that I wanted to achieve money and liberty, and creating Goldmoney was part of that process. I understood that it was more important for me to work for myself, a company that I would form, rather than working for somebody else. But there was more to it than that, because I recognized that currency evolved, and evolution of currency is a good thing. You know, you started with very rudimentary coins. Sir Isaac Newton invented the milling around the edge to prevent clipping. He also invented the classical gold standard. Paper was more efficient than moving coins around. Checkbooks were perhaps more efficient than moving paper around. Then you had wire transfers, et cetera, plastic cards, debit cards, and whatnot. And when I created Goldmoney, I filed my first patent application back in February 1993, long before the internet, before I even knew it existed. But by studying monetary history, I recognized that this is probably the way we're moving. And that patent was granted in 1997. It was one of 4 different patents that were granted to me. And I do believe that what I created, which is called digital gold currency, is going to be the future of currency at some moment in time in the future. When that happens, I don't know. I've been waiting 20 years. But I think it will eventually happen, because what we're doing now with currency is an aberration if you look at monetary history. You cannot take away liberty from people. You cannot take away their purchasing power by inflating the currency. You cannot force them to always accept interest rates that are well below the market rate interest rate, and without some kind of reaction. And I think that reaction is ultimately going to be a collapse of the monetary system, and we're going to go back. I don't think we're going to go to cryptocurrencies, though, because cryptocurrencies are not crypto money. You still have an element of fear there. And also keeping in mind my concept about the Chinese saying that wisdom begins by calling things by the right name. I hate it when cryptocurrency guys talk about mining cryptocurrency. If they understood mining, if they've ever been down like I have in a 2 or 3 kilometers below the surface in a South African mine shaft, you would understand what mining is all about. What cryptocurrencies are doing is they're electrifying currency into existence. Once a gold coin is mined, it exists forever. Cryptocurrencies, on the other hand, have to have a constant generation of electrical power, which is, I think, one of the weak points of cryptocurrencies, even though in the short term I'm bullish. But how I see how I see this resolving itself is that I see cryptocurrencies as a stepping stone out of fiat currency, because it's much better than fiat currency, and eventually into digital gold currency, because digital gold currency is money. It's money that's being used but being sent electronically. And the way this works is that instead of actually walking away from Goldmoney with a piece of paper or a checkbook, you actually click, if you want to make a payment, click a weight of gold or the currency equivalent of gold to someone else, or silver or platinum or palladium, because we deal with all 4 currencies. But as I've found out over the years, more people are interested in saving the precious metals rather than using it as currency. And this relates to something that's also important in the discussion of money and currency. And we're seeing it to a certain extent with the cryptocurrencies. It's called Gresham's Law. Sir Thomas Gresham was the financial advisor to Queen Elizabeth I in England. And he came up with this concept and noticed that bad currencies drive out good currencies. In other words, if you're purchasing something and you have 2 different currencies in your hand, you will use the bad currency for spending and keep the good currency for saving. So what happens with gold and silver is that people tend to keep that good currency for saving, unless you really need it for some reason, or we're saving up gold and silver in order to purchase some good or service at a future date. The same thing is to a certain extent happening with cryptocurrencies, because if you actually look at what cryptocurrency's distribution is, most of it is being held as a store of value rather than being used in commerce day to day. So I do think cryptocurrencies have a role to play, particularly over the next couple of years. And it's also introducing the millennial generation to something better than fiat currency. I was fortunate in the sense that I had the experience of dealing with, as a young boy, silver coins, for example. And I also learned from my parents and grandparents about, gold and silver coins and other things relating to debasement of the currency. But the generation today doesn't have that. So I see cryptocurrencies as a stepping stone, a technological stepping stone out of fiat currency, heading toward what is going to be a better currency, which is digital gold currency. We'll see how that plays out in the years ahead. Money is gold and nothing else. This is J.P. Morgan, who was the top financier of his day, in 1912 in testimony before Congress. Now, you'll often see this quote today reversed. It's saying gold is money and nothing else, because it's sort of difficult for the modern day mind to say, how can the definition of money be gold? Because this is what he's defining here. He's not defining gold, he's defining money. Money is gold. Because to him, he understood the difference between money and currency. But let's look at one of today's top financial brains, Warren Buffett. Gold gets dug out of the ground in Africa or someplace, then we melt it down, dig it another hole, bury it again, and pay people to stand around guarding it because it has no utility. I emphasize that it has no utility. And then to add a little bit of propaganda to it, anyone watching from Mars would be scratching their head, ha ha, gold's a funny thing, we can ignore it. Well, he's wrong. And all we need to do to prove that he's wrong is use a little bit of logic. If gold had no utility, that would mean it would have no usefulness. If it had no usefulness, it would have no price because you wouldn't want it. But today, gold has a price of nearly $1,500 an ounce. So obviously, it's useful to somebody. So he is wrong. And it's sad because this is what his father said in 1948. In a free country, the monetary unit rests upon a fixed foundation of gold or gold and silver, independent of the ruling politicians, just like the framers of the Constitution wanted our monetary system in the United States to be, which we don't have anymore. So poor Howard Buffett, he's probably spinning in his grave to see what Warren has been saying and disparaging gold. This also relates to a little bit about the fear element, but before I get into that, I just want to go through again to show that gold does have utility, that it does have usefulness. And I'm going to show you the price of crude oil from 1950 through December of 2019. And I'm going to show it to you in terms of 4 different currencies. First one is the British pound. And this is a base 100 analysis. So in other words, I assume that crude oil was $100 in each of these currencies, and then I measured month to month, the actual change, to determine what the price is today compared to 1950. So at one moment in time, just before the 2008 crisis, it cost 78 more British pounds to buy a barrel of crude oil than it did in 1950. And even today, it costs about 56 or 54 more British pounds today to buy a barrel of crude oil than it did in 1950. Now let me put another currency on here. This is the US dollar. Now we know the US dollar has been inflated and it isn't worth today what it was in 1950. But as bad as it's been for the US dollar, we can see that it was even worse for the British pound because we're talking about measuring the price of the same thing. A barrel of crude oil today is no different than a barrel of crude oil in 1950. And we're using West Texas Intermediate, which has been produced over this period of time. So it shows a very consistent item which we're using to measure prices. Now, we have the euro. Notice, though, that up until 2000, it was pretty close. What the Deutschmark did from 1950 to 2000 was very, very similar to what it was back in 1950. But since 2000, the euro is looking more and more like the other fiat currencies. The Bundesbank doesn't manage the euro. The European Central Bank manages the euro, and they are following policies very similar to the Bank of England or to the Federal Reserve. Now, this is the key that I want to show you. That's the price of crude oil in terms of gold. An ounce of gold today buys the same amount of crude oil, essentially the same amount of crude oil as it did back in 1950. And you'll see here in 1971 how things started changing. That's when President Nixon temporarily, that's a quote, suspended the dollar's convertibility into gold. It's now been a 50-year temporary conversion, and I think that we're probably going to go back to the mean, which means that at some point in time we're going to go back to gold, and we either do it willingly with the politicians, or we're going to, the markets and everything will force the politicians to do it, because the present system is unsustainable. We can't predict when it's going to eventually collapse, the present system, but it is going to collapse because it is unsustainable. Now, that's gold, and for the silver people out there who want to see the price of silver, that's the price of silver, of crude oil in terms of silver. Now, I remember as a young boy, my parents driving the family car into the local gas station and paying for filling up the tank with $2 silver. Today, you can still take the silver content of those $2 silver and have the purchasing power that fills up the tank of the average family car. Now, the question is, why does gold, why does silver, why do they do this? Why do they preserve purchasing power over long periods of time? There are lots of other examples. You could buy a Colt 45 today for the same amount of gold that you bought a Colt 45 in the Wild West in the 1860s, 1870s, 1880s. You could buy a man's suit today for an ounce of gold. A Roman senator could buy his toga for an ounce of gold. Why does this happen? Well, there are different answers to this, but it all comes down to one basic fact. Gold is dispersed in the Earth's crust in such a way that by applying capital and labor, it's profitable to mine that gold and use it as a form of currency. I want to explain this a little bit more because it's sort of an important concept. We do a disservice to gold, and silver for that matter, when we call them commodities, but particularly gold, because gold's only usefulness as money. Even if you find gold in the form of jewelry, it's basically monetary jewelry. Very, very little is used in any kind of industrial applications. The demand for gold comes from its monetary use. And what we do is we continue to mine, but the technology improves mining. So today, they're mining with heap leaching and other techniques from mines in Nevada that the old timers 80 years ago just walked across because they saw it as dirt. There's a lot of gold throughout the world, but it takes a certain amount of capital and labor to extract that gold and make a profit from it. So rather than having politicians making decisions or central bankers making decisions as to how much money should be created, and whether you argue that this is by design or by chance, but gold is dispersed in the Earth's crust in such a way that the technology enables us to continue accumulating gold by 1 3/4% per annum. And this accumulating gold is the key point that I'd like to make in explaining why it's not a commodity. Commodities are consumed and disappear, or they rot if they're not consumed, or they have different grades. But gold is gold is gold, and it doesn't get consumed, it doesn't disappear. It's eternal. If you've been to the British Museum and seen some of the pieces of gold that were crafted by Anglo-Saxon artisans 2,000 years ago, or some of the Roman gold coins, 2,000 years ago, it's just the same then as it is today. It is eternal. No commodity is eternal. Everything else disperses for whatever reasons. It's a factor of life. Gold is the only thing on this earth that is eternal. It never changes, and that's what makes gold useful as money. And the fact that it's dispersed in such a way, and that the economics of mining can be applied to bring that gold out so that the above ground stock grows by about 1 3/4% per annum, year after year after year, makes gold's purchasing power very consistent over long periods of time, because that 1 3/4% per annum, year after year after year, is approximately equal to world population growth. So you have constant supply and demand. You have 4 forces at work. You have supply and demand of gold, and you have the supply and demand of what you're measuring. And in this particular case, you have West Texas Intermediate. Now, this is going to change in 20 or 50 years when oil is no longer important to our economy. But in terms of other things that like I was talking about, Colt 45s, because I think they're going to be important 50 years from now, or men's suits, gold will still be applied to measure the cost and price of goods and services over long periods of time. So if you can imagine the Eiffel Tower and a block of gold, all of the gold mined throughout history if you could put it together, would slide under the arches of the Eiffel Tower. There's 70 times more steel poured per day than gold mined throughout history. So gold is rare, but it's all over the place. And I'll give you one more example in terms of this purchasing power thing. 120 years or so ago, when gold was discovered in South Africa and they started sinking shafts in order to bring that gold out to the surface, it would take this much gold to sink a shaft, and they were going down maybe 800 feet or something like that. Today, they're going down 3 kilometers, and it takes this much gold to sink that shaft. So technology has a role to play in gold mining, but this accumulated block of gold that's under the Eiffel Tower continues to grow, approximately equal to world population growth at 1.75% per annum. And this is what makes gold the ideal money. It fits perfectly with what Milton Friedman called the K rule. The K rule is to have the weight, have the supply, or the quantity of money in circulation equal to population growth. That's Milton Friedman's K rule. Why he never understood gold as the ideal money, maybe he was a statist at heart, even though he wrote some wonderful books like Free to Choose. Let me carry on, having got to this with just one final point. Fiat currency, 1971 to the present. This is the environment that we're dealing with. We're dealing with currencies that are a problem. We're dealing with Lenin's dictum that you destroy society by destroying the currency. And a lot of today's problems are a direct result of the same thing the framers of the Constitution dealt with after the War of Independence. The first there was a hyperinflation in the United States during and after the War of Independence. The currency at the time was called the Continental. And you may have learned in school books that the saying of the framers was that it's not worth the Continental. It's sort of what happened in Venezuela today. The currency wasn't really worth anything. And so what they did is, in order to create a more perfect union, they brought the wisdom, the monetary wisdom that they carried and their experience into the Constitution. We are ignoring it, and we're dealing with the consequences of that as a result. It will change. Now, just like we measured the price of crude oil in terms of gold, I want to show you the price of stocks in terms of gold. Now, I've got gold grams on the left-hand side and ounces on the right-hand side, and this is the Dow Jones Industrial, measured in terms of how many ounces or grams it would take to purchase the Dow Industrial. So today the Dow is up around, just under 30,000. Gold is just under $1,500. It takes about 20 ounces of gold today to be equivalent or equal to the Dow Jones Industrials average. You can see here at that range, stocks are expensive and gold is cheap, and stocks are cheap and gold is expensive down at this stage. So, back in 1932, at the low of the Great Depression, gold was $35 and the Dow was $35. I remember very well in 1980 when gold was $850, the Dow was $850. And today, we're up here. My view is that they may not be one-to-one, but stocks are expensive and gold is cheap. But of course, I'm talking here about stock indices. The truth is, a stock market is not a stock market, it's a market of individual stocks. So there are going to be winners and losers within that environment. But this concept applies to the indices overall. And you can see the clear delineation between the boom and bust cycle. I was mentioning earlier about how banks extend credit, and then you have the collapse. We had the 1920s credit extension, the collapse in the 30s, the 50s and the 60s, the collapse in the 70s. You had the 80s and the 90s, and then the collapse in 2008, or the internet bubble, if you want to mark that as the peak. And now, since then, we have central banks pushing against the tide with financial repression and all the other things they're doing to try to keep this bubble in the air for a little bit longer, trying to defy reality of what's coming down the road. And it's not just the Dow Jones, this is the FTSE. We live in a global economy. Even back in the 20s and 30s, 1920s and 30s was a global economy. So the cycles that appear in the United States also appear in other countries of the world. This is the German index. These cycles are basically throughout the planet. And it's a cycle caused by bankers because what they're doing is they're expanding the liabilities on their balance sheet to such an extent that they're over-leveraging themselves relative to their capital base. And that is what ultimately creates fear. A couple other things before I get into this fear concept. This is the US federal government finances. This is outlays. And this is by the way, like these other charts that I've been going to be showing, this is a log scale chart. And it makes it easy to see, for example, the distance between 200 and 400 is the same as between 150 and 300. So if the price of, if things were to double, it's the same distance on the chart is basically what that means. This is what the federal government is taking in terms of revenue, and you can see that we're starting to grow a much, much bigger deficit than what had been happening in the immediate years after the 2008 financial crisis. And this is what it's doing to the level of debt. You know, we're 23 trillion now, we're going to be at 25 trillion in the not too distant future. And the federal government thinks that they can do this with no end. They, to their credit, I suppose, think that they can get the economy going fast enough and get enough tax money coming out of the economy to stay ahead of the curve. But the only way they're able to do that for the past several years is keeping interest rates to such a low level that it's reducing the interest expense burden of the federal government. You know, if the interest rates were more normal, 5 or 6% on T-bills, the federal government's debt would already be over 30 trillion, because it's only taking in enough money to spend what it's spending and still leave a deficit. So if you're increasing the deficit by raising the interest expense burden, the financial position of the US government would be even worse. Now, I like to talk about gold as liquidity. And because it's money, it's liquidity that is not contingent upon some bank or some government. I made the point before that gold is money you own. This is over the last 20 years. There have only been 4 years when the average price of gold was actually down on a year-to-year basis. So anywhere along this moment in time, you bought gold, you're basically happy that you're doing it. And that's the whole concept. What you need to do is preserve your purchasing power. And as I've been showing, the way you preserve your purchasing power is to save gold. Just continue to accumulate it, and you'll have that purchasing power for when you need it in the future. I want to go through a couple of charts. Again, these are log scale charts. This is the New York gold price, weekly closing price. I want to show you some of the potential that I think is available in gold and silver. And the reverse of that is how bad it's going to be for the US dollar and perhaps other currencies as well. It's basically a bull market since 2000. We see the 70s bull market there, concluding in 1980, a period of consolidation and another up move. But look at what we have here. We have two nicely formed bottoms on this chart. One in the late 1990s, early part of the century, and then again more recently. Now look at what happened here between 2000 and 2011. Let me draw that chart there, and again, this is a logarithmic scale. Why couldn't the same thing happen again? You know, in 1971, when gold was $35 an ounce, if you had said that gold was going to go up 24 times in 10 years, everybody would have said, you're crazy, it's never going to happen. But in fact, that's what did happen. The point I'm making is that this is not a prediction, because we cannot predict the future. All I'm saying is this is the road that we're on, and we have to think about the consequences. If we want to attain money and liberty, we have to think about the consequences as to what's happening to the currency system that is being used around the world today. Now, I want to say a few things about silver, because silver is not yet in a bull market. It's still below its 1980 high, but what it's forming is a huge accumulation pattern, and I do think that we will move above 50. So if you're talking about gold going up to 10,000 or wherever, silver is going to go well into the hundreds. In my mind, it's just a question of time. But this is the most undervalued asset in the world at the moment, and there aren't that many undervalued assets at the moment. The gold-silver ratio shows it's undervalued. Even though gold is cheap, silver is cheap relative to gold. This is the gold-silver ratio. How many ounces of silver equal 1 ounce of gold? And we've only been at this 90 level a few times in history, and it always comes back. The normal thing that we can expect It was 30 in 1911 when gold got up to 1900 and silver got up to 50 back in 2011. But it's probably going to be a lower ratio than that. Historically, when we used two currencies for our currency, two metals for our currency, the gold-silver ratio was about 16. Geologists tell me there are about 12 times more silver in the Earth's crust than there is gold. So one could argue that, well, maybe the ratio should be 12 to 1 rather than 88 to 1, which it is at the moment. But the point I'm making is that silver is cheap relative to gold. Now I want to show how gold is undervalued. This is the actual gold price going back to 1960. And this is what I call the fair value gold price. I calculate the fair value in a number of different ways. This is using international numbers in order to create what I consider to be the fair value. And I'll explain in a moment why it's fair, but you can see here at the bottom the mathematical formula that I use. It's pretty simple. You take the total quantity of foreign exchange reserves in central banks divided by the amount of gold they supposedly have, which I don't believe is an accurate number, but they don't really tell you how much gold they have out on loan versus how much gold they have in the vault, because they're actually constantly in there trying to keep the gold price contained to make their currency look good. And that's the fair value. And I want to show you a couple of examples. Back in the 1960s, at number one, the actual gold price was above the fair value price. That's when the dollar was as good as gold. Some of the older people in this room will remember, as I do, that was a common saying back there. The dollar was as good as gold, and it was, because the actual price was above the fair value price. Then in 1974, at number two, the actual price got above the fair value price. And again, the dollar was temporarily as good as gold. And number three is 1980, when the gold price at $850 an ounce was well above the fair value at those three moments in time. But look at with this third arrow, we started diverging in the early 1980s, and gold is well below its actual fair value price. The reason why I use this chart is I want to make an important distinction that in portfolio management, to be successful, you really have to get rid of the overvalued assets and accumulate the undervalued assets. And sometimes it's hard to look at gold and try to measure whether it's good value, undervalue, or fair value if you're using dollars or other flawed measuring sticks, being any fiat currency. So this is basically showing that gold is actually undervalued and is worth accumulating. This is my fear index, and it relates to the point I was just making about how do you measure, whether something's undervalued or not. If you look back here in 1971, the fear index had a certain percentage, 1.63%, and we were $42 an ounce. These are key turning points. What that 2.6 represents is that basically, if you remember the balance sheet that I showed earlier, the liabilities versus the assets, this is just the dollar. How much gold is in the U.S. The U.S. gold reserve relative to all of the dollars that are out there as currency circulating, whether in paper or in deposit currency. And when you're below 2.6%, the banks are over-leveraged and gold is relatively cheap. And if you go back to 1915, or 1913 actually, when the Federal Reserve was created, you can see in the Great Depression, the backing was 40%, which is very similar to what the Bank of England backing was when they first created paper currency. They had 40% of the gold versus 100 of the British pounds circulating as currency. So we've basically been in a downtrend as gold has been purposefully moved out of the monetary system by government, but we're going to be going back the other way in the years ahead, in my view. One other historic undervaluation is the mining shares. This is the XAU index of mining shares measured in gold. And you can see there's a fairly consistent ratio between undervalued at 6 gold grams, overvalued at 10 or 11 gold grams, which was the selling area. But here's where we are today. I think this is one of the best buys, one of the safest buys, because you're purchasing a tangible asset, or what I call a near tangible. If you buy the right company with the right management in the right country with the right political risk, which is makes the normal investment decisions that you have to go through on any type of investment, you're buying a very undervalued asset. Now, I just want to wrap up with a couple more things as I have a few more minutes left. Portfolio composition.
This is how I put together a portfolio. You have at the bottom your liquidity and your money. These are your wealth-preserving assets. And what you have to do is look at the different forms of liquidity out there. You look at money, gold, you look at currency, the various currencies, and then pick and choose which one is at any moment in time undervalued relative to the others, and then focus your liquidity needs on that. I think there's a role to play for cryptocurrency in a portfolio, but again, like everything else, it depends on your own personal point of view. What this is all about is sleeping well at night so that we're prepared for an uncertain future. If you're uncomfortable with cryptocurrencies, buy gold instead. Savings, this is your deferred purchasing power. I think gold is a good form of savings, as I showed, that it preserves purchasing power over a long period of time. It's not an investment because if you held an ounce of gold from 1950 to the present, you could buy the same amount of crude oil today as you could in 1950. You don't want an investment that doesn't make wealth or increase your purchasing power, but when it comes to savings, you want to at least preserve your purchasing power so that what you earn today, you'll have that purchasing power at some point in time in the future. Then finally, you have your investments, which are your wealth-producing assets, and you have an arrow on the right-hand side here, which can be moved up and down for each of these different 4 categories to suit your own personal preferences so that, again, you achieve the main objective, which is to sleep well at night. Now, I had a discussion just recently with a very wealthy family, and they were talking about portfolio management and their own particular situation. The numbers here are irrelevant. You could say that's 50,000 or 50 million, as it was in their particular case. The first generation created this little mountain of wealth, and this is time. This is over a span of about 60 years. The second generation has matured, and they're now talking about, well, what is the third generation going to do? The second generation has essentially doubled the wealth, so the mountain of their wealth is approximately twice what it was in the earlier moment in time. And they're talking about they want to double it again, maybe in the next 20 or 25, 30 years, as this third generation matures and takes over the family business. Now, the question I pose to them is, what if 200 is only there because of debasement of the dollar and inflation? So what you really have to do to measure wealth today is you cannot rely on currencies to measure wealth. You have to rely on ounces of gold in order to measure wealth, because only when you're using ounces of gold or grams of gold do you get a true measure of whether you're actually increasing your wealth, increasing your purchasing power. So it's a question mark what that dollar amount is going to be in 20 or 35 years if they're going to double again their mountain of wealth. Leave that with you as food for thought. It is impossible to grasp the meaning of sound money if one does not realize that it was devised as an instrument for the protection of civil liberties against the despotic inroads on the part of governments. Ideologically, it belongs in the same class with political constitution and bills of rights. Ludwig von Mises, the greatest economist of the 20th century. I think everybody in this room will agree with that concept. Where we are today is, we talk about the real estate bubble, the internet bubble, the FANG bubble, you name it. But what we really have today is a money bubble. It's the belief that national currencies are money instead of what they really are, money substitutes circulating in place of money. And we are, I believe, going back to money. It's just a question of time. We're going back to gold. We have to, because if you don't continue to move in this direction, the world is going to end up like Venezuela. So I don't think politicians are going to let that happen. I don't think people are going to let that happen, because I don't think anybody wants to live in a world of Venezuela. Now, Money Bubble just happens to be the title of my last book, so a little advertisement here. But a lot of the concepts that I explained today still useful today because it has a lot of educational material in it. Now, before I wrap up, I'm going to be doing a workshop tomorrow talking about a company that we formed in Goldmoney a couple of years ago. It's now traded on the Toronto Venture Exchange. It's called Manet. It's 24-karat jewelry for men and women. I don't want to get into a full description of it, but we will discuss it. I'm here with Renee Y. who is responsible for marketing Manet. But what it is, it's the concept, if you don't want a gold coin or gold bar, do what people in Asia do, buy gold and have it as a form of jewelry, but do it with Western designs and Western styles rather than Asian styles or Asian designs. And what we've done is, Manet, we partnered with Diana Picasso, who's the granddaughter of Pablo Picasso. She's the chief designer for Manet. It's a new concept. Excuse me, it's doing very well. And if you want to learn more about it, we're speaking tomorrow afternoon, and we'll get into Manet in detail. There is a $20 admission to get into the workshop, but the $20 admission gives you a $20 gift certificate available on your first purchase of Manet jewelry. Manet, by the way, is a word, it's the first known word for the use of, to describe what is money. That's essentially what this jewelry is. It's money fabricated in the form of jewelry instead of being fabricated in the form of coins or bars. My time is up. I'd like to thank all of you for your patience, and apologies for my voice.
Thank you. I hope you found it helpful.